morning, panelists. Saurabh and I were speaking on the way up here because we were on a panel, same time last year, discussing India's macro, and it feels very different sitting here today. Less so because of India's fundamentals, but more so because there's been dramatic shifts in the global economy and the focus moving more towards developed markets versus emerging markets, US and Europe versus Asia, and so on. I think within India, our panelists would agree that we've seen 4 years of slowing growth, policy stagnation, and it's kind of moved people into different camps. There's one group who has written off India. There's another group that still believes in the long-term fundamentals, but a bit exasperated by the pace of reform, lack of exits, and so on. And another group who really sees 2014 as a year of opportunity, and this is the time to enter. So I'd like to start with asking all of the panelists, where do you see the balance of positives and negatives in the coming year? I'll start. Saurabh.
Thanks, Roopa. Morning, everybody, and thanks to VCCircle for inviting me back again for the panel. Where do we see India over the next year or so, both from a macro and an investment perspective? Let me just sort of have a look back at the year ahead. Roopa's absolutely right. When we sat here, when we sat at the VCCircle conference a year ago, I have to confess we didn't quite foresee the extent of current account problems that India ultimately encountered. Neither did we expect the rupee to slide to as low as 67, 68 to the dollar. But the interesting thing is this: in spite of the most prolonged economic downturn that any of us can remember in India, in spite of that and in spite of the currency weakness and the attendant policy paralysis, investments into India, global investor interest into India remains healthy. FII inflows even now in the wake of tapering remain healthy. I think therein lies a clue as to what I think the year ahead will bring. There are a set of underlying strengths of the Indian economy which make it incredibly attractive to investors, not just the FII community, but also, I suspect, the PE, VC community sitting in this room. There's a consumption dynamic in our country which is incredibly robust. That consumption dynamic is fed by underlying pickup in wages that we've seen over the last 5 years. Our reckoning is that blue-collar wages have risen by 15 to 20% every year for the last 5 years. And that's the sort of bedrock of the Indian economy. Strong consumption feeding into a whole range of mass consumption plays which global investors and the PE community have successfully invested in. And I think that aspect of investment will continue. Where I think all of us in this room are looking for some glimmer of hope is what happens on the investment side. Will we see a recovery in capital formation? Will we see a recovery in capex? And will we see a recovery in the heavy industrial capital goods sector, which for the last 3 years has been absolutely eviscerated? There are grounds for believing that the political debate that's currently taking place in our country is healthy, insofar as it will lead to improvement in the investment climate. I think we'll hear in the next couple of months what the two main parties' plans are to improve the investment climate. There's also grounds for believing that the RBI rate hiking cycle probably has a couple of hikes left, and then we'll see a period of rates correcting as inflation eases off potentially from August, September onwards. So I think that the investment side in a way holds the key to the year ahead. Will we see an improvement in capex? My sense is we will see industrial growth rising from around 2% in the current fiscal year, the year to March 14, to around 4% in the year to March 15. It's not a massive recovery in industrial growth, but it's a turn. It's a turn in the industrial cycle, which is where I think the bulk of the upside lies in the year ahead. It lies in swinging towards investment plays, towards cyclical plays, and that's where we are advising a lot of our clients to do extra incremental investing. The consumption story is well appreciated, it's well understood, it's well valued. The investment plays, I think, are where the disproportionate upside of the year ahead will be made. One word of caution before I hand over to my other panelists. It's the banking system. If there's one thing which keeps me awake at night about our country, it's the state of the banking system. I think there's deep distress in banks' balance sheets. As everybody in this room knows, we've got this famous thing called restructured assets, which in August 2008, the RBI famously created. If you add up restructured assets, add up NPAs, you're getting close to 11% of the banking system loans being in distress. Even if you make the very reasonable assumption that only a third of those will ultimately end up in losses for the banks, that's a good 40% of the equity capital of the banking system wiped out. We've heard that there are plans for recapitalization of the banking system if the opposition comes to power, but honestly speaking, recapitalization won't be cheap, and I don't think it'll happen very quickly. So I think the banking system will continue to act as a drag on India. Overall, we've been telling our clients that this is the time when you invest in India with something like 12 to 13% one-year horizon, but if you take a 2 to 3 year horizon in India, this is as good a time as any to come in.
I think Saurabh talked about most of the positives that he would be expecting. I was definitely not here in the same panel as Roopa and Saurabh last year, but I think the dynamic shift that has happened is more related to the external world vis-a-vis India rather than the local economy vis-a-vis India per se. I'll just explain. I think the biggest shift is the fact that the quantitative easing out of the US Federal Reserve in terms of the liquidity that was flowing into the emerging market space has weakened in a very significant way. And to that extent, it's not that we suddenly had a current account deficit of a 4.8%. We were building onto the current account deficit of a 4.8% for even the 3 years before we actually hit the current account deficit of 4.8%. So it was nothing new that sort of hit us. What really hit us was the fact that global liquidity, which has helped most of the emerging market space in terms of wishing away the negatives that were there, that were building up anyways within the structural dynamics of the overall, all these economies, that became exposed in a very significant way. Now, that really keeps me worried in the sense that as we went along in 2013 and as we saw the huge currency fluctuations, we had this new definition of the fragile five. And 4 countries out of the fragile 5 actually goes in for elections. So I think the overall investor sentiment towards the emerging market space continues to remain weak, in my opinion. I'm not sure how much of upside potential in terms of growth that we are likely to see for the Indian economy and for the emerging market space. Yes, we are seeing some amount of turnaround that might be happening in the export cycle because the overall the developed market space is doing relatively better. But I think there are still significant risks out there in terms of the rebalancing of those economies. So I would sort of not really want to build in a pre-Lehman type of a growth story even for the developed markets and therefore for the emerging markets. So I think on the growth side, yes, we may be bottoming out, we may sort of look a little bit on the higher side, but dimensional changes need to be made in the Indian economy with respect to its structure and with respect to how we actually look at inflation. Now, Saurabh just talked about the rural wages and the urban wages, and I think it's clearly because of the huge amount of policy missteps that probably the current government has taken up, and which is basically the Rural Employment Guarantee Scheme. And the Rural Employment Guarantee Scheme, the wages have been jumped by almost 150% over the last few years, which has really made the agriculture more costly as an affair. The MSPs have been going up. The Rural Employment Guarantee Scheme wages have been linked to the CPI, agricultural labor. So those chains in terms of the wage price spiral that has become quite ingrained in the economy needs to be broken. So the first thing that politics need to realize, and this is where we would be struggling as a globe as a whole, is the divide between the politics versus the policy. While policymakers would want to look more than 5 years into the future, the politics would want to look maybe only 5 years into the future. So, and I think all these socialist, crony socialist sort of schemes that are running in the economy, which has actually been the bedrock of the inflation dynamics, needs to be killed if you want to see the next round of uptick for the Indian economy. And it's also related to the interest rate cycle for the economy.
Good morning, everybody. 2014 is, in my view, likely to be a year of adjustment for the Indian economy. Now, one big adjustment has been made, which is on the external side. With the rupee depreciation, the current account deficit, which was at a high of 4.8, has been brought down to a very manageable 2.4, 2.5% levels. So that adjustment has been made. But there's at least 3 other adjustments which need to be made. And 2014 is likely to be a year where we're going to see, hopefully, some progress on each of those. The big one is inflation, as Indranil pointed out. India has been running nearly double-digit inflation for about 4 years on the CPI. The central bank has just de facto moved to an inflation target. They've said that we need to tackle inflation come what may. They're going to focus completely on inflation to the absence of other factors, which I think is a move in the right direction if you want to tackle this problem. They've set a target for themselves of 8% by early 2015 and 6% by early 2016. And they're taking steps to ensure that they reach that. So that is an adjustment which is clearly underway. The second adjustment that needs to be made is on the fiscal side. We know that India's government borrows too much and spends too much. The interim budget laid out a plan of getting to 3% by FY17. He put out a number of 4.1 for FY15, which is very challenging. But the new government will have its task cut out for itself. It has to consolidate on the fiscal by removing subsidies, by incentivizing capex, and by garnering revenues. So when monetary policy is tight, controlling inflation, and fiscal policy is tight, that's normally not a good time for growth. But that is a much needed adjustment so that as we look out into 2015 and beyond, we can get a new cycle starting. The third adjustment, apart from inflation fiscal, is the balance sheet adjustment. Saurabh referred to the balance sheet problem on the banks. That is a serious concern. Balance sheets of banks are strained. NPLs plus restructured assets are the highest in Asia by a big distance at 10.2%. Provisioning is weak and banks need to raise a lot of capital. So if that were to happen, their ability to lend to the corporate sector is going to be impeded. And if you combine that with the fact that corporate leverage is also extremely high at this stage, India needs a huge round of equity where all of you come in. So I think that that deleveraging process has to happen in 2014 as bank and corporate balance sheets have to improve. And certainly measures taken by the new government will be important in this regard. So I would say as we look out into 2014, as long as we get progress in these adjustments, then the medium-term prospects could look very good. But if we try to cut corners, if we try to stimulate growth at the expense of inflation or the fiscal deficit, if we try to grow the balance sheets where there is not enough space, then that could cause problems further down the road. So it's a cautious outlook on 2014, but certainly much needed one given the go-go years between 2003 and 2010.
So I'd like to just push back on a couple of specifics within the view. I think the first one is, and we can't avoid talking about, is the rupee. And I feel like I've heard 2 different things. Indranil, if I can sort of talk about how you spoke about the external adjustment. In your view, India had a current account deficit for a long time. It was business as usual. Tapering, the threat of tapering occurred, and all of a sudden we were part of the delicate emerging market economy basket. The other view is that India became more externally vulnerable leading up to tapering and now has made this improvement and is in a much better position going into the next round of tapering. So I guess with that kind of, those 2 views, how do you see the rupee playing itself out over the next, say, 6 months, 6 to 12 months? Maybe we can start with you, Kishan.
Sure, I think the rupee is probably one of the most interesting currencies globally because it has had a huge move. Only the lira or the rial come in mind as currencies which have had such a large move in such a concentrated period of time. But my view is that the adjustment is largely over. If you look at it in terms of equilibrium exchange rates, the rupee is neither massively overvalued or undervalued. Normally currencies tend to trade depending on inflation differentials, purchasing power. And if you look at the rupee over the last 10 years, it's moved from about 50 in 2003-04 to 62 currently. So about a 2% depreciation a year, which is roughly what the inflation differential would have mandated. So it was sort of a much needed adjustment that happened. Although adjustments never come easily, they normally are a step jump. Now, looking forward over the next 6 months, I actually see pressures on the rupee to appreciate rather than depreciate. Because the current account is shrinking a lot faster than anybody expected. And that's because demand is so weak. So if the current account is shrinking, just as the high current account deficit led to a weakening rupee, a shrinking current account deficit helps the currency. And if you see the flows that are coming in and may be incentivized after the elections, then that could go into putting more pressures for currency appreciation. So I think the near-term pressures are certainly positive, and that's the sense that we get speaking to our FX traders and clients around the world, is that the rupee is a currency that most of them are looking out for as a standout currency in the emerging market space. Beyond 6 months' time, I think the inflation dynamic will take over. So unless India gets its inflation rate down quickly, you go back to the 2% a year kind of depreciation phenomenon that we've been seeing for a really prolonged period of time in India. So I would say pressures to appreciate in the near term, but unless India gets inflation down, there could be some depreciation on a 2 to 3 year horizon.
I think in terms of the rupee, I'm not as confident as my friend. And I think the key issues that I need to highlight here is that the RBI has probably managed the rupee within the 62 to 63 band because of this huge amount of resources that it managed to garner through the swap window, which was about $34 billion. But the point that really needs to be noted is that the leverage of the country, so far as the external sector is concerned, has really gone up. Now, within that 34 billion, almost 7 billion is basically 1 year debt, and that really needs to be repaid within a 1 year period. Now, yes, the current account has shrunk, but let's look at how the current account has shrunk. It is basically an iron hand on the gold imports. But we have not really done anything much in terms of addressing the demand for gold into the economy. So the way I would probably look at it is there is still continuous leakage that is happening in terms of the gold imports coming in, but it is not really reported on the official channel. So that's one sort of very important issue to me. And the moment we have sort of seen a current account being contracted to about a 2.5% of the GDP, we have again started actually talks about how the gold import duty can be brought down, and if the new government sort of looks at it in a more sort of reduction of the duty structure, then I think we can have a separate type of a problem. The other thing that really sort of is important to me is in terms of the non-gold, non-oil imports that are there. And I think the resource management of the country is really a big issue over here, whereby we have coal resources in the economy, but we are actually importing a lot of coal today. We have built up steel capacities, but we are once again importing a lot of metal scrap to keep those steel sort of units in operation. So there's a lot of structural issues that we need to address so far as the overall current account dynamics is concerned. And therefore, I think as we go along, the most crucial factor to me, which I can't wish away, is the elections, the type of political system that comes up. Yes, we have a swing in terms of sentiment towards the BJP possibly at this point in time, but unfortunately the point that needs to be noted, and which is very important to me, is we are possibly putting only Mr. Narendra Modi as the Prime Minister of the country. Now, it depends on what is the type of seats that the BJP as a unit actually sort of gains post-election, and therefore the policies, what are the type of fiscal policies that they come up with, what are the steps that they come up with in terms of sort of managing inflation in the economy becomes very important for the rupee at that point in time.
Okay, we'll move on. There was another question that came about the impact of China's slowdown on India and what that could mean in both the coming year as well as in the medium term. So, Tushar, do you have any views about that follow-up?
Sure. I think China's slowdown affects India two ways, at least two ways, and then I'll talk a little bit about the broader global scenario for India as well. The first is the direct sort of export demand. That's not huge, although China has become one of our major trading partners, the top 3 trading partners for India. So it does affect exports at the margin. But I think the bigger impact is through commodity prices. A slowdown in China has clearly had a big impact on the iron ore market, on the coal market, on demand for oil, for copper. And we're seeing a significant pressures for prices to fall in these markets. Now that's actually good news for India because we import most of our commodities, and to the extent that we have to pay less for coal, as well as for presumably at some point it's going to translate into lower oil prices as well. That's good for India. So I think it's a good phenomenon that China is slowing down at a time when India over the next 5 to 7 years will ramp up, because it means that we're not sort of competing with a huge commodity importer head to head. So that's a good development. But the other supply conditions have not been created, and Indraneel touched upon those on the manufacturing side. So then all of this has built up into a major employment problem, and that is particularly felt on the female labor force, which, as we were discussing, the female labor force continues to shrink. India's urban female labor force participation is at 18%, 1/8, the lowest in the emerging space. Amongst all the countries that we look at, this is the lowest number. China has it in the mid-60s. So, if we want to increase productivity, if we want to reduce inflationary pressures in the economy, raise productivity, and sort of take advantage of this whole demographic dividend that we talk about, we've got to get these people into the workforce. Now, why do I say this in the context of inflation? Is because it has a completely direct bearing. If you're not able to mobilize factors of production to producing output, you're going to get inflation. And that's what we've been seeing, is that CPI inflation has been very high. I think that there is a direct link, and the causality works both ways, between rural wages and food inflation in India. Because rural inflation has been so high, that is translated into CPI inflation, and it has become this whole genie, which is very difficult for the RBI to bring down. So I think it's going to be very difficult for the RBI to bring CPI down. I think 8% is manageable. Because if you take away some of the one-off pressures on food, then you can bring it down, but from 8 to 6 to 4, which is their mandate, is going to be incredibly difficult. It means increasing productivity, it means getting a lot of labor into the workforce, and it means squeezing wages. And that is the best way to squeeze wages, is when you increase supply. So that is a tall order which is clearly beyond the RBI's control. It has to be a concerted attempt. And the hope is that the new government starts policies which can start moving India in that direction.
Sir, we got an interesting question from the audience. How do you feel foreign investors are likely to react if the BJP does not come to power?
Look, last 2 elections, 2004 and 2009, investors of all shapes and sizes, FIIs, DIIs, I think the investment community misread the direction of the election results, and then even after the results were announced, they chose the wrong decisions on the day of the announcement. So I think both for stockbrokers like me and for the investment community, I think it's a very difficult exercise to first call the result correctly, and then even after the result is known, to actually make any sense of it and make the right investment call. If you recall, on the day of the 04 victory, when it was apparent that the NDA was out and the UPA was in, the stock market actually fell, and then we had the best rally ever in our country's history. 09, the situation was the other way around. We had a gap up the day of the UPA's victory, and we all know what's happened in the last 5 years. So I have to confess, I really don't lose that much sleep about calling the election result. There's a lot of client interest in the subject, and we write about it. We've tied up with some opinion pollsters. We write about it, but I don't think too many people can make money by trying to preempt election results. Where I think there is money to be made is by trying to figure out where does policy move. And I'll just give you one construct which strikes me from this debate. I think Tushar spoke about what's happening in China. Now, there's a bigger question that China's plight raises for all of us. If you look at the purchases if you look at who's been buying US government bonds in the last 5 years, between the Fed and the Chinese government, something like 95% of US government bonds have been bought between the Fed and the Chinese government. Now, we all know what the Fed is doing about buying government bonds. They're tapering. My reckoning is the Chinese are also throttling off on their purchases of US government bonds. Now, if the two biggest buyers of the US government bonds throttle off, then I think that we all know what will happen to US bond yields. They'll go up. Now, in the 30 years since 1981, in the last 30 years, we've had the greatest bull market ever in government bonds, in US government bonds. US bond yields have gone in a straight line almost. They've gone down for 30 years. That's resulted in the cheapest cost of capital that I think any of us can ever remember, that I think has been seen in modern times. And one of the reasons we are all sitting in this conference room in Mumbai is that the fall in government bond yields has created a demand from US investors to put that money in countries such as ours. Now, if that bond cycle turns around, if the bond yields now go up for 10 years, you can see what that means for India. And that's where I think my panelists here are right to raise a serious issue as to what happens to investments in markets like India. US bond yields structurally trend up. I think the consensus view out there seems to be they'll go toward the 10-year bond yield, will go to something like 4.5. But if it continues going north after that, it has a serious bearing on how much money comes into India. Now, my reckoning is people in the RBI are cognizant of this risk. And given that 2/3 of India's savings, we save something like $500 to $600 billion a year. Believe it or not, India saves $500 to $600 billion a year. 2/3 of that goes into gold and real estate. 2/3, something like $300 to $400 billion goes into gold and real estate. We have to find a way, whoever runs this country has to find a way of channeling some of that savings into the productive economy, into agriculture, into industry, into the private equity community, which is why I was so intrigued to hear Sahad say that there'll be a couple of panels on local capital raising. We need our own money to fuel our own economy, because I think the time when we could look to the West and say FII and FDI will lift our boats, I think is broadly gone. We might not get a 30-year rising period in US bond yields, but in the foreseeable future, US bond yields are certain to go up, and that is negative for foreign investor inflows. Will the RBI, will the policy establishment respond to that and liberalize laws so that Indians put their own money in the Indian market, into the Indian financial system?
I'd just like to close with one last question. I think we've been focusing a lot on the next 18 months, which is what you normally do looking at the economic data. But the timeline and the time span for this audience is further out, 3 to 5 years. So maybe, Tushar, if you can take this question. Saurabh talked about the opportunities that he sees macro level in specific sectors. What do you see over the next 3 to 5 years? Either as the biggest opportunities or also similar to the rupee, maybe a risk that's not on the horizon that we're not focusing on.
So in terms of opportunities, I think one of the biggest opportunities is in the export space. As we've been all saying that the exchange rate has clearly become more competitive. And if I look around the Asian neighbors, the fragmentation of production from China is leading to footloose investments everywhere. Investments are going to Vietnam, Bangladesh, Myanmar. At some point, these investments will come to India, as long as we can sort of generate an ecosystem to take that in. And I think the next government will be seized of this issue. So I think that that is a great opportunity and a historic opportunity for India. The other huge global trend that is going to help India is on the commodity space. As I mentioned, we are seeing a structural decline in commodity prices, and given how much it impacts the macro and individual businesses and input costs, think about coal supply or iron ore inputs or any of these inputs into the power sector or other sectors. There can be a significant diminution of those if the trends in commodity prices continues for the next 3 to 5 years, especially as the shale revolution plays out in the US and nat gas prices come down. So I think these are the two big mega changes. And then of course there are a huge amount of micro opportunities which if the new government were to follow policies which can sort of incentivize manufacturing and industry, this could be a great opportunity and a great time to invest. Simply because the economy has been shackled by the lack of progress on these things for several years. I wouldn't sort of put a timeline as to when we have done that, but we have to shift away from incentivizing capital and disincentivizing labor to incentivizing labor and take advantage of the abundance of labor that India has, and that can unleash a huge amount of investments and opportunities.
Thank you. I think with that, our time is done. Thank you to my fellow co-panelists, and thank you all.